That sound you hear is the door closing on a July Fed rate cut. Live from Studio One here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Bonnie Quinn. We're kicking you off to the closing bell right here in the United States. So let's get a check on where markets stand after that blowout jobs report, but blowout in many ways. The S&P 500 really unchanged. It hasn't changed that much for stock investors, it would seem, or else they're just waiting to make their decisions next week. However, for the smaller cap stocks, we are seeing a decline of 1%. Huge apathy towards smaller cap stocks. Of course, higher rates, not great for those smaller businesses. Increasing job growth, you would think, would be good for those businesses. People have more money to spend, but that's not being reflected in valuations, in stock prices. And then the real move, right across the curve, we are seeing a move of about 12 to 14 basis points, Romaine. So we're headed right back up to that 5% on the 2-year, potentially.
A lot of activity in the Treasury market, and that had to do with the jobs report this morning. The pace of job creation in the U.S. really just blowing past all expectations. 272,000 new non-farm positions, and that was more than what every single one of the 77 economists in the Bloomberg survey had predicted. While the unemployment rate did edge up to 4%, wage growth doubled from April, reigniting inflation fears and prompting traders to pair expectations for the Federal Reserve's first interest rate cut. That's the setup heading into the Fed's 2-day policy meeting next week, a meeting backdrop by today's jobs data and next Wednesday's Consumer Price Index report, data that will guide the central bank's quarterly update of economic and rate projections for the rest of the year and into 2025. Goldman and Nomura were among the big banks who already shifted their base case for a cut from July to September. Economists at Citigroup and JP Morgan today finally adjusting their outlook to the fall as well. And Mohamed El-Arian is telling Bloomberg Television that anyone expecting anything sooner is kidding themselves.
There's no way they can cut or signal a cut in July with this data. They would have to change their reaction function and be public about it, and I don't see the Fed doing this. So that's why the door is shut. There are no spare tires in this economy. So if you get it wrong and you weaken too quickly, it's going to be a very difficult mistake to correct.
That's the Fed's problem. This is investors' problem. And if you had been playing volatility and rates this year and you happen to get it right, boy, are you deserving of a huge bonus. Look at what we have seen. We were at 7 rate cuts potentially right before the beginning of the year. We've been up and down, up and down, up and down ever since, but basically coming down to 1, maybe 2 this year. That may be reflected next week in the FOMC meeting. We are anticipating that rates will stay at 5.25% to 5.5%. But where will that median dot be? That's the big question.
Yeah, it feels like the entire narrative all year long, Bonnie, has really all been about a shift in expectations from week to week, from day to day and month to month. Charles Lemonides joining us right now. Always a constant presence for us here on The Close. Valueworks founder and CIO. All right, you saw the numbers this morning. It was a blowout. Did it give you any sort of clarity about what the Fed is going to do next, or are we just still kind of in that same churn that we've been in for a good part of this year?
It did 2 things for us. One, it absolutely gives us clarity that the Fed is not tightening, not loosening anytime soon. Tightening maybe, but not loosening anytime soon. But the other thing it did for us in terms of clarity that's at least as important is give us increased confidence that the economy is growing with today's interest rate levels. So that we've adjusted to much more expensive money, and there's fundamental demand regardless of, that's not being driven by zero interest and free money. So what's driving the economy is the real investment opportunities that businesses are finding and the real demand for their products. And they're adding employees because there's work to be done, and that's even with Fed funds where they are. So, I don't think the Fed has a reason to change course, and I think that investors should be happy with the state of affairs.
And it's a great point, though, too, about corporate fundamentals. We're still talking about markets, at least for the S&P and NASDAQ, sitting at record highs, even today after that jobs report. And it gets to this idea that companies are still finding a way to make money, and ultimately, at least for investors, that's all that really matters.
That's right, and they're finding ways to grow their businesses. And yes, on the one hand, we're at all-time highs, that's true. But on the other hand, we're not that much higher than where we were 2 years ago. The markets have broadly paused, And over this past 2-year period, by a lot of measures, equities have become a lot cheaper than they were 2 years ago at the same level. So there's a lot of runway for upside from here.
There's so many cross currents, right, Charles? Because on the one hand, we're seeing all these AI stocks and companies that are using AI and beginning to buy chips and so on, really see a huge amount of enthusiasm from investors, and that would portend perhaps fewer jobs in some of those areas. And yet we're seeing an economy that's creating jobs, creating demand. How do you reconcile those two threads?
Well, there's a couple of things going on. One, the actual work of creating those AI networks, whether it's building out the data centers or creating the energy for them to use or building the chips, that's real work, and that's fueling economic growth. And the other thing that's happening is that there's a wealth effect that's going on. You know, huge wealth has been created in these investment opportunities, and that wealth isn't necessarily going to go away because the investment opportunities really are real for AI. You know, I don't know what we're going to be doing with AI 5 years from now, but I'm sure it's going to be a big deal.
We are seeing unemployment at a 4 handle, but we did see a huge amount of job creation. What does a small business CFO decide to do with that information? Because on the one hand, there will be more demand from consumers for their products, presumably, if we can believe the data. On the other hand, there absolutely won't.
The biggest challenge for many businesses over the past couple of years has been to meet demand, and to meet demand without needing to raise prices and increase their costs. Yeah, you're seeing that in industry after industry, and so yeah, that's a really good problem for them to have. And yeah, there aren't enough workers to fill all the jobs out there, but 4% unemployment is a little more room than 3.8.
I'd be remiss in not asking you about kind of the AI theme, the AI trade, and particularly for someone like you who is a value investor. I'm wondering, do you look at any of these AI names, whether it's NVIDIA or Microsoft, AMD, whatever, do you find any true value there as an investor, as an entry point at this stage? You know, in the 4 names that have captured everyone's imagination and enthusiasm over the past 6 months, 4 years, you know, NVIDIA especially, no, there's, yeah, you don't want to bet against it because of the momentum it carries, and the great business dynamics they have. Yeah. But it's a $3 trillion valuation. You know, explain to me how you're going to actually double your money in that investment in the next 5 years. That seems like a real stretch. But there are a lot of other companies that will benefit from the explosive use. And so we're in those names. And we try to build a diversified portfolio with that type of exposure. And you know, our number 1 name there is Micron because you know, you need more memory chips to power this stuff. The cycle has inflected. They're going to be earning significant amounts of money next year and the year after and the year after if this boom carries on. So I think there are value ways to get at the AI boom. You just have to be thoughtful about how to do it.
Micron has had a huge run-up itself, so why pick Micron as opposed to another chip company, for example, Intel, or somebody else that seems to be making moves? And I also want to ask about your EV play, Rivian.
Well, Micron's had a big move, but it's, you know, it's $150 billion equity cap. It troughed at $75 billion equity cap. It's a double. But the real AI growth stories are triples and quadruples. And Micron is up modestly from its peak at the last cycle, but not by orders of multiple. And they're earning $9 next year and trading at $130. That's just not a tough stretch. And there are other chip names out there. You know, we own Qualcomm. We think the valuation there is still good. But the chip stocks that haven't moved, for the most part, haven't moved for really good reasons. You know, their challenges in their business and their challenges in their competitive position is very real. So, you know, there will be losers in the sector, and you know, figuring out which ones where there's not a lot of good news that will turn out to have good news is really hard.
All right, Chuck, always great to talk to you.
Whoa, you missed Rivian.
Oh, Rivian. Look, Chuck, we're almost out of time here, so we got to go. We're going to get you back and talk Rivian.
That's a tease.
Charles Lemonides there over at Valueworks, a deep tease there here. And any eagle-eyed viewers out there have probably noticed that we've actually been on a different set for the past couple of weeks. That's because we are constructing and relaunching the close. That kicks off on Monday, June 10th, and we really want you to join us because we are starting big. Apple co-founder Steve Wozniak going to be joining us. So too is the former IBM CEO Sam Palmisano, Bond King Bill Gross, Mercer's U.S. Chief Investment Officer, as well as former India Central Bank Chief Raghuram Rajan. All this huge lineup all week long. Be sure to join us right here on The Close on Bloomberg. That starts Monday at 3 p.m. with myself, Scarlett Fu, and Alex Steele. Meanwhile, our coverage continues here today. When we come back, a deeper dive into today's job report and an update from the White House. Gene Sperling, White House advisor, going to be joining us in just a second. Plus, we're also going to talk about what it means for federal rate policy with some insights from Nathan Sheets, Global Chief Economist over at Citi. And as we count you down to the close, we're going to jump into all the market action with Jay Woods, Chief Global Strategist at Freedom Capital Markets. Don't go anywhere. This is The Close on Bloomberg.
This is a really strong report.
Stronger than what people were expecting going in.
This jobs report is not recessionary. It is soft landing.
It does close the door on a July rate cut.
I think the Fed would still like to get a cut or two done.
There's no way they can cut or signal a cut in July with this data.
I still think September you target as doing that.
The reason we think the Fed is going to be able to cut in September and December is because we think that inflation is going to proceed with moderation.
At least as it pertains to equities, I think the Fed pushing out when they're cutting is good news.
There are no spare tires in this economy. So if you get it wrong and you weaken too quickly, it's going to be a very difficult mistake to correct.
The view from Wall Street on today's big blowout jobs report that we got earlier today. Stronger than expected U.S. jobs, 272,000 created. But once again, it is a tale of two reports. Let's get some insights from the Biden administration directly. Gene Sperling, White House American Rescue Plan Coordinator and Senior Advisor to the President, joining us right now. And Gene, we talk a lot here about this report as being one thing, but there's two surveys in there. An establishment survey of employers that came in well above expectations, and a survey of households that came in well below expectations. The question isn't whether the labor market and the economy is good, it's why don't households think it's good?
Well, as you said, I look over this year as a whole. You have 247,000 as the average for 2024. I mean, that's an extremely strong year. You take out the president's last couple of years, that would be stronger than any jobs year in over 20 years. So this is strong. But you've seen in the jolts, you've seen some moderation. But I think we should all be happy to see the American labor market staying strong. And I think really, if you'd been a year ago and somebody'd said, we can bring the Fed's favorite inflation measure, PCE, down to 2.7, core PCE down to 2.8, and be averaging nearly 250,000 jobs a month and still be, it was just barely under 4% at 3.96, but under 4% unemployment for 28 months in a row. That is, fairly Goldilocks, in terms of getting it, feeling quite right. And you saw wages at 0.4%,
yes,
which is going to be above inflation. So we are at a period now where the average worker is having wage gains above the rate of inflation. So I think on the whole, we should feel quite good about the resilience,
yes,
really the extraordinary resilience of this recovery that, we believe was helped by the American Rescue Plan and other supports. And I think has surprised a lot of the forecasters.
Yeah. Do you think that resiliency, is that going to continue? At least do you see sort of the elements there that can keep this going?
Well, I think you do see, elements of moderation. So, for example, you saw job openings starting to return to more normal levels. You've seen some things in the economy that, are soft landing-ish, but they're still, a strong degree of resilience. You really can't think about 247,000 jobs as even soft. It's kind of a good landing place, but I think so far there's a lot of promise here. And again, I think resilience has been the key. We said when we were having that rocket growth in 2021 that the goal was going to be able to transition to employment and growth that was strong but more sustainable. I think this is really meeting that as well. And of course, it's always a mix, right? You see some of that moderation and you say, that looks pretty strong, but then you worry. Then somebody can say, well, but is that a sign things are going to moderate too much? When you see a jobs number like this, I think it's got to give a lot of people a lot of comfort that this recovery is still resilient, and that having so many people working and people starting to get real inflation-adjusted wages offers a lot of promise for the future.
So, Gene, as you say, more jobs in many, many areas, higher wages. How much is a re-acceleration of inflation a concern to this White House, particularly as we head deeper into campaign season?
Well, you know, obviously this is an issue of great discussion people have. I think what a lot of people think is that, you know, people are often frustrated by the price levels. So they look at something in the grocery store and actually it's coming down, or inflation's very low, or something like eggs is a great example. I mean, you've had deflation, but it's still higher than it was in 2020 or 2019, or, you know, so people, so the inflation, I think, you know, again, 2.8 core PCE inflation is not a particularly worrisome number in itself. Are people still frustrated because of the pandemic and prices being a little higher? You know, yes, you see that, but it's also very interesting that when you ask people how they are doing, strong majorities say they're doing pretty good. So you have this world where people are kind of saying that they're doing pretty well, but they still seem to be expressing, at least to pollsters, some worries, but their actions don't show that worry as much. You see consumer spending strong. You see amazing small business applications, which is the ultimate confidence in economy, to be starting a new business. So, you know, this is not a simple gauge. I would say there's, you know, a bit of resilient unhappiness with the pandemic and prices and the supply chain issues. But you see people feeling better about their own circumstance, and you see in their actions the spending, the starting of small new businesses, that people are still expressing some confidence in this economy.
Hey, Gene, always great to get your take here directly from the White House. Gene Sperling, White House senior advisor to the president there. We'll be back in a moment right here on Bloomberg. Let's get a view from the sell side with our top calls. The big movers on the back of analyst recommendations, and we start off with Vail Resorts, having one of its worst days since the pandemic after the ski resort company slashed its EBITDA outlook. J.P. Morgan's Matthew Boss, not a fan of the move, downgrading his recommendation on the stock to underweight, citing key headwinds, including pushback by skiers after 3 years of price increases. Those shares down 11%. Skechers up next, an upgrade to buy over at Bank of America, which cites an improving wholesale environment for the footwear company, as well as second half management outlook that the analyst says could prove conservative. The analyst also sees promise in untapped markets overseas, in China and in Latin America. Those shares up 2%. And finally, let's take a look at Lyft. Impressing a slew of analysts after its investor day, Gordon Haskett raising its neutral rating to buy. As for all that skepticism surrounding management's financial targets, the analyst says that's simply creating a low-risk, high-reward buying opportunity. He also praises Lyft's price lock feature as a way to attract and retain users. Shares, though, down fractionally on the day, and those are some of our top calls. Now, we are happy to have the analyst behind that call with us now, Bobby Mollins, Director of Internet Equity Research over at Gordon Haskett Research Advisors. And Bobby, before we get to it, we actually had a chance to catch up with the Lyft CEO, David Risher, earlier today. Listen to what he had to say about how he would make good on its gross bookings forecast.
Customer obsession is what gets us there, right? I mean, we're a scale business. We're a scale business. We do 2 million rides a day today. We're going to get to $25 billion in bookings over the next couple of years. That just means doing more of what customers like, picking them up faster, pricing better, and then innovating, like with Women Plus Connect and some of the other things we've talked about before. It's really the basics, but you do them really well over and over again, and you can grow an incredibly big and profitable business.
And Bobby, that was, of course, the CEO over at Lyft. You had a chance to hear from him directly at that investor day here. You buying it? You think there is a plan? And more importantly, you think he can execute it?
I do. I don't think they would come up with some targets that they couldn't achieve. And, I'm still a little bit skeptical myself, just kind of like everyone else is. But I do think it does create a buying opportunity for the long term.
How much do favorable rulings regarding things like Prop 22 and other regulatory matters mean to this company right now, Bobby, and its share price?
I think it means a lot. The reason why is because if Prop 22 does get upheld in California, that creates a legal precedent for other states that may try to do something similar. So it actually makes the path forward a lot easier for not just Lyft, but all gig companies out there.
You used to be able to, I feel like, arbitrage Lyft and Uber, and now it seems like a Lyft driver is an Uber driver and vice versa. How do they sort of unconfuse that? Are all drivers on all platforms at this point?
I think so. We have the mindset that, if someone is on the Lyft platform, chances are they're on Uber and vice versa. And both companies seem to be aware of that. And it's up to the management teams to create the best possible driving experience to keep those drivers on their platform. And both companies have done a pretty good job of doing that.
When we talk about sort of what David sort of laid out too with the advertising strategy, I mean, there are a lot of components now swirling around Lyft that didn't really seem to exist, or at least they weren't promoted a lot publicly over the last couple of years. Is this going to be kind of the broadening out of the business that I think a lot of investors had looked for?
Yeah, we think so, but it's still early on, so it's kind of to be determined. But both companies seem to be executing pretty well on the driver supply side.
All right, Bobby, thank you so much for that. Price target now of $20, up from $17. That is Bobby Mollins over at Gordon Haskett Research.
Yeah.
And Romain, I don't know if you tend to use Lyft or if you use Lyft on Citi Bike or what you do.
Yeah. Well, I mean, I use all the ride apps here, and I don't know. I mean, I think the advertising strategy is interesting. The Women Connect strategy is also interesting. The idea that maybe they make people feel like their service is somehow safer than the others, and that's a way for them to steal market share. It's interesting because we always talk about Uber as having two sort of modes, if you will. They have the ride share, but they also do the delivery, food delivery, something that Lyft has avoided.
Exactly. Lyft is staying true to its roots, although it has moved into transportation, has moved into bicycles and things like that as well.
Now, you're one of these people. You ride those city bikes around the city? That's dangerous,
at nighttime when no one can see me.
Nighttime,
very early
well, just
hours
wear
of the morning.
a helmet. People drive crazy. And
They
now
are.
that Hochul has gotten
They're
rid of our,
difficult.
congestion pricing, we're all, ooh.
Well, we're going to talk economy with Nathan Sheets in a few moments, Global Chief Economist at Citi. Stay with us on The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostick.
And I'm Vonnie Quinn. And I do want to mention GameStop, Romain, because it was one of the major stories of the last few days. In fact, up 47.5% yesterday, down almost 40% right now, having had many, many trading halts throughout the day. Keith Gill seemingly disappointing investors, but also GameStop itself coming out and maybe preempting some of what Keith Gill would have had to say by releasing earnings 3 market days earlier and announcing, a bigger share sale.
Yeah, it was kind of interesting that GameStop did that. You kind of wonder sort of what was going on, why they would move up their earnings report. I don't know. Did you actually watch the Keith Gill video today? Because it was bonkers. And I mean, like, at some point you're like, okay, dude, like, get to the point. What's the fundamental case? And he did eventually make the case here. But as you see here, it didn't really move the stock. Well, it did move the stock, but just in the wrong direction.
I was, perhaps like you, one of the almost 500,000 people waiting for it to start, just to see what was he going to say. And of course, it was rambly at the beginning. But then the basic fundamental point was that he didn't have a new case. He said we were on to part 2 of his original thesis. And I'm sure many, quote-unquote investors were anticipating maybe.
So that's one of the big movers here on the day in the equity market. I think some of the other big moves are in the Treasury space, Vonnie, and of course all that has to do with that big jobs report that we got this morning.
Yeah, so we've gone from absolutely the opposite of fundamentals to fundamentals, and that's what you can see in the Treasury space. As you say, back to the jobs report and what it means for the Fed's rate path. Earlier today, we talked with Acting Labour Secretary Julie Su. We asked her what the numbers actually say about the broader economy.
The payroll survey is the survey that tells us how many jobs have been created, what industries they've been created in. And again, the growth we're talking about is not just single industry, right? It has been for the entire time, but certainly this last month is no different, very, very broad base. We have historic job growth, low levels of unemployment. I think it is the very definition of a soft landing.
For more perspective, let's bring in Nathan Sheets, Global Chief Economist at Citi. So Nathan, before we get to the Fed and what it might have to do with the data that we saw today, where did we go wrong? How do we not see that these jobs were likely to be created following 3 days, basically, of employment data?
Yeah, great question. Great question. Well, first of all, it is notoriously difficult, and I can tell you this from experience. It's notoriously difficult to forecast these monthly NFP releases. They are very, very volatile. But I think underneath that, we were reminded yet again that this is a very resilient U.S. economy. And we have had some data that have pointed to a moderation in activity. And there was an argument, well, is that a harbinger of a sharper slowing? Or is that the soft landing that we've all been hoping for? And these data suggest, these labor market data this morning, suggest that there's still a fair amount of momentum in the economy, and certainly does strengthen the case of those arguing for the soft landing.
It certainly does, Nathan, but Mohamed El-Erian was making the point a little earlier on Bloomberg TV that perhaps the Fed is too late. And it's difficult to reconcile the idea that the Fed might be too late cutting rates with an economy this strong, right?
I understand that case. That's very much the economy has softened some. And once it starts to soften, it tends to soften more non-linearly. But I do think that this time is fundamentally different. We're coming out of the pandemic. We knew the economy was too hot. We were calling for a moderation, a cooling in activity. We needed a softer labor market. That was the Fed's objective. And, all in all, I think we're getting that moderation. And I think underneath it, there's still plenty of strength in demand. So I understand the concern that, well, maybe things are going to soften too much.
Yeah.
I just don't think we ought to take that as the base case at this stage.
I mean, is there even an argument to be made, Nathan, if you had a seat at the table there at the FOMC, is there even a case to be made at all for easing policy anytime soon?
I think it's a stretched one. I think the Fed at their meeting, they're going to look at where the economy is, and they're going to say we have time. And I think they're going to wait for more evidence that inflation is clearly on that 2% trajectory that they've been working toward and to which they desire. Now, as they wait, they will be vigilant. They'll pay careful attention to what's happening in the economy. And if some of these signs of softening do seem like, if they appear to take hold, then I think that the Fed will respond to that. But I don't think there's a strong case to cut at this meeting or really, as you said, anytime soon.
I want to ask you kind of a somewhat esoteric question, Nathan, and that's really about the reliability of this data. We had some news break a little bit earlier about how BLS is actually going to reduce the sample size on the household survey. Now, this is primarily because of budget cuts and not because of anything else, at least what we know publicly. But, there's been a lot of hay made out of the dueling surveys, the establishment survey, the household survey, how these two intertwine, and whether we truly are getting an accurate picture of what's going on in the labor market.
Clearly, there's a lot of noise in the labor market data. I think that's the reason you want to look at a whole range of indicators. But when I look at the claims data look pretty solid to me. The average hourly earnings number that was part of this report, I think, continues to point to some labor market tightness. As I said, there's some other measures, really more about the soft data that suggest some more marked cooling. But all in all, I think that this is a moderating but still solid labor market. Now, final bit that you alluded to is there was a wide gap between the establishment survey, the overall employment number, and what was embedded in the household survey. But I can tell you that the Fed, and I was at the Fed for many years, has historically taken a lot more signal from the establishment survey and sees that as being much more reliable, notwithstanding the fact that even that has some challenges.
Nathan, Citi now expecting a first rate cut in September and not July. That's a little bit of an outlier call in the sense that we are just 6 weeks to 2 months away from the election. A central bank would love to not even have the appearance of being political, right? And there will be a lot of people saying the rate cut cycle cannot possibly start before the election or that close to the election. Would that give you a pause at all in this Citi call?
Continuing to draw on my experience inside the Fed, I think the DNA of the Federal Reserve is to follow the data and seek to do the right thing at the right time. And if the data are suggesting that the economy is ready for cuts, and cuts are consistent with the Fed's dual mandate, I think that the Fed will not hesitate to cut, even in September in the heat of the presidential election. Now, as I say that, I think that has got to be the headline. But at your point, though, in quiet moments, when Jay Powell is sitting in his office and he thinks about pros and cons, if he can make a case a little bit earlier, a little bit later for the cut, and it's not right in the heat of battle, I think he'd be happy with that as well. So it's complicated.
All right, Nathan, going to have to leave it there. Always wonderful to talk to you. Have a great weekend. Nathan Sheets, Global Chief Economist at Citi. Stick with us. When we come back, we're going to talk about one of the big movers on the day and, well, one of the biggest IPOs of the year. This is Bloomberg. All right, there's a new kid on the block, and well, it started trading today. It's time for our stock of the hour, and we're taking a look at shares of Waystar, the fourth biggest IPO of the year and largest by a U.S.-based company. The shares pricing at $21.50 last night. They did open below that, trading below that now, down about 3% here on the day. It's a healthcare payment software maker, and the CEO of that company joins us right now. Great to have you here on the program. Let's talk a little bit, and Matt Hawkins. I'm getting ahead of myself here.
Thank you,
Matt, great to have you here on the program.
Delighted to be here.
First of all, congratulations. I mean, it's always a feat to bring anything to market, particularly in this environment where it's been a lot harder for IPOs to sort of get traction here. Why did you feel it was appropriate for you to come to market now?
We feel like we're building a durable, high growth, highly visible business. And it's a testament to the work that we do with over 1 million providers who use our software across every setting of care. We feel like coming to market now gives us more awareness of who we are and visibility to our company, the value that we bring to providers. Gives us a sense of credibility as we work to establish trust with the clients with whom we serve. And then certainly it's helped us improve our capital structure. We were able to delever the business through the proceeds of the IPO. Our investors are in the business and along the journey with us, believe in what we're building. We were fortunate to add a number of additional investors through this process, so we're thrilled.
Yeah, you're going to have a lot more investors here. I mean, it's a lot different being a public company. You have a lot more people you have to answer to, and that gets to be a little bit of a grind versus being a public company. Talk to me about the growth strategy. This is a company that had, at least last year, roughly about $800 million in sales. What is the growth plan, the growth story that you're pitching to investors?
Healthcare is such an important category for all of us. The pains that we're helping provider organizations to resolve as they use our cloud-based software platform that, by the way, has artificial intelligence throughout our platform to automate work, to prioritize and organize work, and to create operating efficiency. We tell that message to clients and potential clients, and we show them a real way to create lasting return on investment. And we're fortunate. We have referenceable clients. We serve over 1 million providers across every setting of care, and we're market leaders in client satisfaction. So all those things contribute to strong win rates, long relationships with clients, and that becomes an important part of our growth story.
EQT is still going to be your largest shareholder, about a 29% stake. Also, Canada Pension Plan, Investment Board, Bain Capital, Francisco Partners. How much of a say are they going to have on day-to-day operations, and how much are they going to want to see a return?
We have fabulous investors. They are on our board of directors, but from the very outset, EQT, who I'm very appreciative of partnering with, they have asked us to behave as though we're a public company. So we've had a number of independent board members join our board prior to this event, and we govern ourselves accordingly. So while they have a say, they're wonderful thought partners, and they trust us to lead and guide the business.
All right, well, Matt, once again, congratulations on pulling this off in a week where there was a lot of noise, a lot of distractions, and some of the other big IPOs didn't manage to do it this week. So that is Matt Hawkins, CEO of now public Waystar.
Thank you so much.
Coming up, Jay Woods, Chief Global Strategist at Freedom Capital Markets, will speak these markets, particularly on a day post non-farm payrolls when the market is now looking ahead towards next week's inflation data and the Federal Reserve meeting once again. This is The Close on Bloomberg.
This is the countdown to the close. Romaine Bostick alongside Vonnie Quinn here on the final trading day of the week, Vonnie, and it is not looking good here. Stock's been on the back foot for a good portion of it, moving deeper into the red now that those closing bells are just 10 minutes away.
For sure. Having hit another record this week, we should mention, for the S&P 500, but we are backing off that ever so slightly. We had been flirting with the unchanged mark all day, but now we're at 53.49. No huge catalysts here today, except for, of course, that jobs report, which did put a bit of a spanner in the works, particularly for the bond market. But I do also want to point out the small cap Russell 2000 index down more than 1%. A very different reaction for small cap investors than for large and mega cap investors, potentially looking at other things coming out of this jobs data. But the 2-year yield, look at it, 4.88. We're not far off that 5% mark. Once again, we've hit that maybe 4 times in the last year. Will we hit it again? Well, we'll have to wait for next week to see. But certainly rates aren't coming down as fast as we might have anticipated yesterday. The 10-year yield back at 4.4296.
Yeah, one of the biggest moves that we've seen in those benchmark yields in about 2 months here. As we continue to count you down to those closing bells with just about 9 minutes to go, let's bring Jay Woods into the conversation. Chief Global Strategist at Freedom Capital Markets, joining us here in Studio One. And Jay, I'm going to give you some optionality here. We can talk about that boring jobs report. We can talk about the boring treasury market. We can talk about all the boring moves out there right now. Or we can talk about Roaring Kitty, GameStop, and this, I don't know, train wreck of the live stream that he had just a couple hours ago?
That's far from boring.
Yeah, okay.
And all-time new highs are not boring either.
Yeah.
And amazingly, we are making those. So we're seeing a lot of mixed signals in this market. Let's hit on Roaring Kitty right out of the gates, because sadly I fell into that trap, and I had to watch that train wreck of I don't even know what to call what we watched. But there was a lot of hype around this. The fact that GameStop released their earnings today and not like they were supposed to last week, they took advantage of the move. He is still in love with GameStop. He was very careful in his wording, because the one thing we're watching for is, manipulation. Is there anything illegal? He's done nothing illegal. There's nothing wrong. Yeah. He's got a big following. We see 13F filings, and Warren Buffett says he owns Chubb, and boom, Chubb goes up 15%. Yeah. Now, he's no Warren Buffett. Let's not make the comparison there. But this was the show, and unfortunately, this is what people were talking about today, not that jobs number. And let's go boring then.
Well, let's go boring because, I mean, we kind of bring it up because it kind of gets to the heart, though, of where market sentiment is right now. And Vonnie points out, look, we're a down day, but like I said, we were at a record high yesterday on the S&P and NASDAQ. So sentiment is still overall still there, maybe not for GameStop, but certainly for the broader market. Yeah,
but it's not broad, as Vonnie said. The Russell is down again. That 10-year yield, 4.35%. As a technician, as someone that follows price action very closely, we were pretty excited to see it break 4.35, and the 200-day moving average. Well, it got back up there. It got back up there quickly. It's not alarmingly high. It wasn't a spike. CPI. Watch the CPI next week, same day as the Fed meeting and press conference. It's going to be a doozy, but the CPI of any other economic data point, that causes more volatility. The VIX is down today. We had a little sell-off, but it's bifurcation. The haves are rallying, the NVIDIAs of the world, the mega caps are rallying, and then you have to be selective as to what rallies within which sector. I look at the consumer staples, talk about boring. Okay. It's a sector that is about to make all-time closing highs. On a monthly basis, I know we're very early in June, but we are right now at all-time monthly highs if it was to close right now. This is very positive. Then you look at the top 5 stocks in that sector, the Costco's, the Walmarts, the Procter & Gamble's, Coca-Cola, Philip Morris, all 5 new highs this week, I think today. There's strength there, and that's boring, but that's where people are rotating to.
Just one more question on GameStop before we leave it, Jay. I mean, at what, 28.49, we haven't even erased yesterday's gain, even though the stock was down 40%. It rose 47% yesterday. Are there any fundamentals to support that kind of a stock price, given that we also saw more dilution today, 75 million shares? We saw earnings, which weren't earnings, they were a loss. And Keith Gill doesn't have any new information that he's giving away yet. He's just saying he believes in Ryan Cohen still. Same thesis.
Yeah, that's the story. There are no fundamentals. Yes, they did have a capital raise, so that could help them over the long term. But their earnings were out. They missed. They were down 29% year over year on sales. That's not what you want to see out of a growth stock. So fundamentally, no, it will eventually calm down, get back to the fundamentals. This has been a nice sideshow. It's been very fascinating to watch. It's the sequel to the movie, basically, is what happened. And, you know, how long this will last? Probably not much longer.
So anyone who did have the cash to put into GameStop, assuming they haven't lost it, where should they put it now instead?
Well, I'm always the long-term investor, and you know, you put money into the S&P 500, the SPYs, the Qs, and then, you know, buy companies you know. I would still put money into NVIDIA. I think that's where the biggest growth is. The biggest customers for NVIDIA are the mega caps. Yes, it's a little overdone, and the RSI is, you know, getting exceedingly high. But I think on pullbacks after the split, you know, digest, it may go sideways for a little while, but a long-term story, the mega caps are still where you want to be. Technology is where you want to be. And short-term, if you're a little nervous, staples are looking good too.
I am curious, though, on NVIDIA and that stock split. I know technically stock splits aren't supposed to matter, but do you think it could matter just in terms of generating more interest, generating more of that retail trade? Could that provide some more momentum?
I'll tell you who it mattered to. My father, who owned 10 shares, and now he's going to have 100. When you own something like that, you feel like you win. But when you look historically at some of the mega caps, Tesla and Apple back in 2021, they both had sizable stock splits. Tesla ran almost 30% when they announced the split to when it actually split. So people want to get in. There's this sense that I have more. Now, we both know that you have the same amount. The market value is identical. But there is this sense of pride, sense of winning, that you can brag that I had the stock that split. It's psychological, it's behavioral, it is not fundamental, that's for sure.
We have had a huge run up, though, and there is skittishness here. Anytime there's any kind of a headline that's maybe negative, like, for example, the regulation headline yesterday, we're seeing a drop in the stock by 3.5%, and there was a 10% drop, remember, maybe a couple of weeks ago. So. Is there a word of caution here on NVIDIA that we might be fully priced for where the company is at right now?
Well, NVIDIA is always going to be volatile, and we had a 20% correction last year, went sideways for 5-6 months. It's going to take you on these roller coaster rides. Taiwan, China, that story, if that gets any bigger, that will be a major headwind for them over the near term. But right now, when it comes to competition, they were on the stage with AMD. Intel announces another chip, and guess what goes up? NVIDIA goes up. So right now they're eating their competition's lunch and they're enjoying it. And the growth trajectory, they already talked about the 2026 chip. They haven't introduced the 2025 Blackwell. They're talking about Rubin, I believe is the name. The growth is there. The user base is strong. The demand is unbelievable. I'm in the Dan Ives camp that this is still early innings in the AI play, and NVIDIA is the way to go.
Yeah, absolutely. And I was just taking a look at the weekly gain that we're seeing in NVIDIA right now, up for 7 straight weeks on NVIDIA. And believe it or not, that's not even the longest win streak this year for NVIDIA. Jay Woods over at Freedom Capital Markets. Stick with us. We are counting you down to the closing bell. Stick with us. We're about to take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Bonnie Quinn. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast. We're joined right now by Tim Stenovic and Emily Grafeo as we welcome our audiences across our Bloomberg platforms. That includes television, radio, and yes, Tim Stenovic, those folks still watching us on YouTube.
We're everywhere. You can't get away from us, which is fine on a day like today, which is a Jobs Friday. I got to tell you that with the data that we saw come this morning at 8:30 Wall Street time, I was expecting a bigger reaction with the equity market, given that we're kind of seeing this reset when we think the Fed is going to cut rates. Just not seeing that with equities today.
It's all about the bond market.
Nothing happening.
It's all about bonds.
It is all about the bond market.
That's what Bloomberg's Michael McKenzie told us earlier today. And you look at that market, we have the 2-year up almost 16 basis points, a big sell-off there in the market after that hot labor market data.
You have to wonder if this whole idiom of sell in May, go away just doesn't work this year, right? We're at record highs, and even if we're seeing a slight sell-off, I mean, I'm not sure you could even call it a sell-off. It really is in individual names and individual stories.
Yeah, and we talk about this idea coming off those record highs from earlier this week here and setting up for what is now going to be a weekly gain for both the S&P and the NASDAQ. The Dow Jones Industrial Average also clinging to a weekly gain. But the Russell 2000, those small caps, the mid caps, the transports, all lagging this week once again.
Yeah, I mean, I think the question that I have is how this data that we got today when it comes to payrolls, Romaine, changes what the Fed at least does in its dot plot next week, which we'll get on Wednesday. It's kind of the next big catalyst.
Yeah, those economic projections are going to be huge because they are going to have to make some shifts because so much has changed in the last few weeks since the last one we got 2 meetings ago. Let's walk you through the numbers here on this Friday afternoon. The bells ring, people clap, and the markets are down. The Dow Jones Industrial Average lower by roughly about 88 points or about 0.2%, though it is going to finish higher on the week by about 0.3%. The S&P 500 lower by 6 points or 0.1%, even though it's going to finish higher by about 1.3% on the week. Similar story for the NASDAQ Composite, a drop on the day of 0.2%, a gain on the week of 2%, while the Russell 2000, that has been your laggard on the day and on the week, a 1% decline here on this Friday afternoon and a more than 2% decline on a weekly basis.
Okay, peeling back one layer at least of the S&P 500, we did see 187 stocks move higher on this Friday, 313.
Can you name all 187?
No. I mean, I got to tell you, just ahead of the gainers and decliners, slim pickings.
Okay.
Today.
All right,
slim
there you have it.
pickings.
Deep tease.
Yeah.
Tell you what might be a surprise. The banks rallied. JP Morgan best among them, up 1%. If you look at the IMAP, you'll see that the financials did the best. And after that, looking at IT companies and so on. Many sectors, though, were in the red, including utilities, staples, many of those defensive plays. So it was a really bifurcated market, a little bit of risk on, and at the same time, that jobs report and the possibility of higher for longer rates definitely impacting things. Obviously, it's good for banks in certain ways if there are higher rates.
You know, I did say it was slim pickings when it came to gainers. I did want to go with Apple, though. Finished the day higher by a little over 1%.
It's a bold call.
It's a bold call. Worth, any excuse to talk about WWDC next week and what's going on out there in Cupertino, which, of course, we'll have live coverage of throughout the day and throughout the week next week, is worth talking about. According to our own Mark Gurman, WWDC this year will focus on, Romaine, I'll give you one guess. What do you think it'll be?
I don't know. What is it? It's going to be AI?
It's AI.
Oh,
that's
okay,
right. Yeah, you're right.
So does this mean that they're actually going to make Siri useful?
Yeah, I think Siri's pretty useful. I don't want to say that word over and over again, or else my phone's actually going to go off.
Oh, I disabled mine.
You did. So maybe that's why it's not useful, because you disabled it. It has gotten increasingly useful.
I don't like them listening in.
It's been around for more than a decade. I think it's gotten pretty useful recently. But yeah, could be getting a lot more useful. Deep integration of AI in apps, summarization features. It'll recap articles, web pages, and Safari, sum up meeting notes, text messages, and emails. The question I have is who's getting texts long enough that need summaries? So
summary of a text.
A summary of a text message. Also a password manager.
If somebody's texting you text that long, then you have to need to summarize. Just cut them off. Just block their number.
That's a good idea. Yeah. All right, Apple up 1.2% today. Automakers, actually traditional ICE automakers that work on internal combustion engines getting a bit of a lift today, including General Motors, higher by just about 0.2% today. This after the news that the Biden administration is easing requirements for automakers to increase the fuel efficiency of new cars following industry pushback. So here's the data. Car makers must reach an average of 50.4 miles per gallon across their fleet by 2031. That's according to a final rule that was announced today by the U.S. National Highway Traffic Safety Administration. That new standard is a 1.4 mile per gallon increase from 2026, but it's less than the 58 miles per gallon that the agency had proposed previously. So the idea here, it's better for companies that are working on cars that use traditional internal combustion engines, and not as good for those EV companies that, of course, have EV motors. And Yext shares moving higher on the day today. A little potential M&A news, higher by 9%. The company preparing to explore a sale after attracting takeover interest. This according to a report earlier from Reuters, who cited unidentified people familiar with the matter, Emily.
All right, well, Carol Massar is out, so that means Tim gets to do the gainers.
I get to
and
do the
he
gainers.
gives me the decliners, and he was very excited
Womp
about
womp.
this for whatever reason. But I'm happy to talk about the decliners. Let's look at DocuSign, now down only 5% at the close, but down as much as 10% on an intraday basis. Biggest drop since March 2023 after the e-signature company forecast billings for the second quarter that fell short of estimates, and that stock down despite the fact that the revenue forecast was better than expected. I'm also looking at Vail Resorts, ticker MTN. Get it? Mountain. This is a ski resort giant, and the shares dropped as much as 12%, biggest intraday decline since the height of the pandemic, March 2020, after they slashed their full year total reported EBITDA outlook and published third quarter earnings per share that missed estimates. Analysts reacting negatively, with JP Morgan cutting its stance on Vail to underweight from neutral. And finally, we are still talking about GME, GameStop.
There we go.
It's actually up over 20% when you look at it on a weekly basis, but today falling over nearly 40%. Just a lot of volatility all around. They reversed a pre-market climb. The video game retailer said in a filing it may offer and sell up to an additional $75 million shares of a Class A common stock. But I'm going to say this share decline is all about the Roaring Kitty live stream. Maybe investors just not thinking that it lived up to the hype that it was supposed to be. We had over 500,000 people watching that live stream. Romaine Bostick was one of them.
I certainly was here. I couldn't take my eyes off of it. Not sure you wanted to put money behind it. There was a lot of volatility in that stock. There was also a lot of volatility in the bond market today, particularly in U.S. Treasuries on the heels of that jobs report. A massive spike in yields, 14 to 15 basis points on the shorter end of the curve, 11 to 12 on the longer end of the curve. And we should point out that these numbers, these are some of the biggest daily moves that we've had all year long. It's at least the biggest daily move going back to mid-April. And if you remember what happened on that day, I think it was April 10th, when we had that shock CPI report to the upside that really rattled folks. This really does seem akin to that, where a lot of people were really taken off guard, folks. Everyone thought 272,000 jobs, no one thought. 77 estimates in a Bloomberg survey, not a single one was at that number.
The question is, does this provide yet another buying opportunity? If you missed the last 4 buying opportunities, Stephen Major has been big on this at HSBC. You know, the 2-year yield has hit 5% several times, and investors, perhaps not the first time, not the second time, not the third time, maybe not even the 4th time, trusted that they should get in. Is now the time, or are we going to go higher once again?
Well, that's why I was so surprised to see such a muted reaction from the equity market, given that it might change what the Fed was going to do this year. And if that happens, then, you know, the way that investors value these stocks using discounted cash flows will change, because rates will change, Emily. So it was a really surprising reaction, at least in the equity market, given what we saw in the bond market.
Yeah, and especially when you think about what had happened earlier this week with stocks kind of shrugging off the JOLTS data, but the bond market reacting really heavily. It seems like for the equity market, at least before the bell and the declines right before the bell, they just don't seem to mind.
Yeah.
Bad economic news is good. Good economic news is good.
Well, this really does set us up, though, because next week is going to be huge. We get a CPI report in the middle of the week, which happens to come on the same day that we get that Fed announcement. There's a lot of other cross currents out there. So what better reason than to launch our show,
Oh.
The Close, a big relaunch, and we're actually going to be in a brand new studio, Tim. Unfortunately, you won't be there. You and Carol have to stay in the radio booth. But
hey, we'll have our time.
Yeah, one reason why we've been on this set for the last couple of weeks, they've been rebuilding ours. And this is more than just about the optics here. This really is a refresh and a closer look here at just how important the final hour of trading really is, guys. This is critical. You talk about the volume in this market. The majority of that volume comes in the final hour of trading, really in the final half hour of trading. And you're not going to really understand what's going on, and more importantly, what the setup is going to be for the day after, unless you're watching us here at that time, right here on Bloomberg. Look at those pretty faces that we have on the screen right now, Tim. You want to read them, or should I?
You go ahead.
Steve Wozniak going to be joining us on Monday. Former Apple co-founder, the former CEO of IBM, Sam Palmisano, the Bond King, Bill Gross. Olu Alagana going to be joining us over at Mercer, and Raghuram Rajan, of course, former India central bank chief, also going to be joining us. And really, that's just 5 amongst, I think we have something like 75 people joining us next week. I could be off on my count here, and they're all wonderful, Tim.
You're setting it up to be really high expectations, Romain.
Yeah,
so,
I know. Overpromise and underdeliver. Isn't that how it goes?
I think that's not what we say. Hey, it's been great being with you guys on Beyond the Bell. I look forward to whatever happens on Monday in the new iteration of The Close. Looking forward to that. And also, I wish you all the best weekend, because that does it for Beyond the Bell, our cross-platform coverage of the market close on Bloomberg Television and Radio, Bloomberg Originals and YouTube.
Is Emily going to be here too?
On Monday, she's not going to be here. Carol will be back.
Oh. Yeah.
Okay.
But you know what?
I'll be here later today covering the S&P 500 rebalance.
Okay, there we go. You can look forward to that. Have a great weekend, everyone. We'll see you later.
All right, a lot more coverage coming up here on The Close, the deeper dive into those labor markets we got today, and a closer look here at where the labor market is going in the future. A conversation up ahead with Debbie Dyson. She's the CEO over at OneTen, whose mission is to hire, promote, and advance the talent pool of folks who actually don't have 4-year college degrees. You don't want to miss that conversation. It's coming up in a bit, right here on The Close on Bloomberg.
Welcome back to The Close. I'm Bonnie Quinn.
And I'm Romain Bostic. A cross-asset look at how markets closed out the day and on the week. Markets, at least on the day, were back in the red here, but we did see that rally on a weekly basis continue here for yet another day. But most of the action today, you were going to find that in the rate space. It was a big part of the reason why you saw the home building index down 2%, and that was because, well, benchmark rates were up 14 basis points, one of the biggest moves higher that we've seen in benchmark rates going back to April. And that day was significant because that was when we had that surprise CPI report to the upside. A repeat today here this morning when we got that surprise labor market report. A lot of questions right now, Bonnie, here about the trajectory of the economy and, more importantly, the Fed's reaction to it.
Well, and let's look at some of the day's biggest movers, Romain. We will start with GameStop. It is a slightly separate story to the Fed story and the job story, obviously, but a huge amount of volatility. And even with this huge of a decline that we saw today, we are up over the last 2 days because we rose 47% yesterday. Fundamental data out this morning, more share dilution and also earnings, which were a big loss. But then, of course, the roaring kitty story, and a lot of people had bid up that stock yesterday. They were seemingly disappointed, or they had made their profits, or what have you, but there was a massive, massive sell-off today. In fact, the stock was down 20%, very close to the open. It went almost back up to flat on the day, and then fell completely once that delayed videocast did actually start, because he had really nothing new to say except that he still believes in Ryan Cohen. 3M, an interesting one. Bank of America, the latest to upgrade to a buy. That makes 6 analysts now on the street that say 3M is now a buy. A lot of clarity when it comes to the legalities and the issues surrounding 3M when it comes to payments on, contaminated water supply and potentially faulty earplugs being sold to militaries. And that really has that stock perhaps making a run for it a little bit higher. And then I did want to point to NVIDIA, because we didn't see a huge move in NVIDIA. We are, of course, waiting for the stock split to come into effect next week and anticipating perhaps a move, but maybe not in the early days of that. We have seen a nice run up in NVIDIA all week, perhaps in preparation for that. But our top story this hour, so much for a slowdown. U.S. non-farm payrolls added 272,000 jobs last month, well above expectations. The unemployment rate did take up to about 4% from 3.9%. Fed swaps no longer fully pricing in a rate cut now before December. We've heard that one before, Romain.
All right, well, a little bit earlier, our very own Joe Matthew had a chance to catch up with the acting labor secretary, Julie Su, and he had a chance to ask her about that hot jobs report. Take a listen.
The unemployment rate has remained at or below 4% for 30 months straight. That's still the longest since the 1960s. And at the same time, real wages, over the year are up 4.1%. So workers are doing better in an economy in which the president has said, when we focus on workers and worker well-being, we're going to do what's right for the economy and for the country.
Secretary of Labor Julie Su there in conversation just a little bit earlier today with Joe Matthew, the co-host of Bloomberg's Balance of Power, joins us right here on The Close. And there were two interesting takeaways I got from that interview. We didn't show you on camera. First of all, Joe, the fact that you actually dealt with the heat and the sweat there outside. I forgot those swampy days in D.C. But more importantly, her response to you when you kind of asked her about kind of the disconnect between what the numbers are showing and what people on the ground, voters, are actually feeling.
Yeah, it's interesting, Romaine, because, you've got a labor economist here in Julie Su talking about really a political matter here for the White House, and they're taking a victory lap, and it's her job to talk about this massive payroll numbers. But we do see some weakness under the hood, and I'm not an economist here. It's my job to ask questions. You can't deny that we're seeing two different results in the establishment survey and the household survey, which includes agriculture, and a lot of questions right now about the role that immigration is playing, and that includes illegal immigration. It's something that appears to be unquantifiable at the moment. But we saw a study that I mentioned to her from Steve Englander at Standard Chartered that said as many as 109,000 jobs a month could be coming from undocumented folks crossing the border here. And after Joe Biden signed that executive order earlier this week, we're wondering what the numbers are going to look like in the months ahead.
Well, that's exactly where I was going to go, Joe. You presented that to her. Did you get any sense that the administration has a plan if the outlook for the labor market changes with more policies from Joe Biden if he were to be elected again?
I did not, to be perfectly honest with you, and I was struck to hear the labor secretary have to articulate to me there on the steps of the Labor Department that the majority of job gains have come to native-born Americans. The fact that that has to be delineated by an administration is a pretty remarkable moment, to be honest with you, and there is a potential that we're going to see an impact here in the numbers. That also comes along with legal immigration and the lack of reform that has left many employers wishing that they had access to H-1B, H-2B visas, and this is something that Washington just once again can't seem to get its arms around.
Joe Matthew there, the co-host of Balance of Power, every day, 5 p.m. Washington time, right here on Bloomberg. A sit-down with Julie Su, the acting labor secretary, and she did make some interesting comments, too, about the complexion of the labor market, the idea that you are seeing gains for minorities. You are seeing significant gains for women. In fact, she said that women were actually powering the economic recovery. Now, one person who's really had her pulse here on the labor market is Debbie Dyson. She's the CEO of OneTen. OneTen's mission is to hire, promote, and advance the talent pool of those folks who don't have four-year college degrees. I'm pleased to say Debbie joins us here in studio. One, talk a little bit more about that, because when we talk about the expansion of this labor market, I don't mean in the short term, I mean long term. It has to be more inclusive, not just in terms of race and gender, but it has to be more inclusive in the skill set and, more importantly, the training that people have.
Yeah, absolutely. Yeah. I mean, if you think about what's happening and you look at the report that came out today, it's kind of a tale of two cities. On one hand, you're actually seeing this growth in terms of opportunities for jobs, for good, talented people. But on the other end of the spectrum, what you're starting to see is, like, for people of color, the unemployment rate actually hasn't changed. It's actually gone up, and specifically for black and brown talent. Mm-hmm. So if you think about the role for OneTen, what we're trying to do is really identify those opportunities for those that basically haven't been seen. These are individuals that typically do not have a four-year degree. Mm-hmm. 66% of Americans actually do not have a four-year degree, but yet 60% of all of our jobs actually require one. So when you're sort of taking the job data and saying there are good, meaningful jobs out there, how do you take the skills of individuals that typically are ignored or not seen for great potential and skill them for those actual jobs where the demand is actually in need?
And your organization talks a lot about this idea of skills first.
Correct.
Kind of explain, though, I mean, that's very broad. So kind of explain, what are the skill sets that are going to have more traction in this economy, at least as we can sort of visualize out?
Well, again, going back to the report, if you think about it, I think there were 3 or 4 industries that actually saw growth. So you have healthcare, we saw things in hospitality, you're seeing a great deal in terms of like logistics. So what we end up doing is you take all of those job industries and you say, what are the 3 or 4 skills that are actually required for those particular industries? And then you train talent specifically for that. So, you know, if you think about whatever your degree happens to be, mine happens to be in finance. What I do as I sit here today has absolutely nothing to do with finance. However, you can teach me the other things with sort of on-the-job training. So what OneTen is trying to do is ensure that the talent has the skills that match the jobs, and at the same time ensure that they have the right soft skills to prepare themselves as they enter corporate America.
Where do you get the training, though? Because you don't get the job until you at least have shown an aptitude for that kind of area. Community colleges in the past have been a powerhouse for feeding this labour market. Is it possible to leverage community colleges for perhaps people of older generations or different backgrounds?
Absolutely. I mean, I think what's fascinating about what we're doing, it's this ecosystem where you have the coalition, which we call our companies, and then you have these partners, talent developers. So like a community college that create micro pathways that say if you're interested in a role in healthcare, here are the things that we will actually teach for you. But we have other partners like talent developers that specifically are skilled in technology, healthcare, manufacturing, hospitality, and they're creating courses that could be 3 to 6 months, and after that period of time, they get a certification and hopefully a gainful employment.
How does AI come into it in the last year or two? Morgan Stanley has done this great sort of chopping up of companies that are either now enablers or they're adopters or they're disrupted or they're, you know, other things related to AI. How do you think of that when it comes to the skills that you're trying to impart to these people?
Well, I mean, there's a couple of aspects. So if you think more tactically, I would say from an AI standpoint, our ability to actually accelerate identifying resumes and skills that are required is going to have to go at a faster pace. The jobs are obviously increasing, and we need to get labor or talent into those jobs as quickly as possible. AI can play a tremendous powerhouse in that. The other piece, though, is actually training talent to sort of code for AI. So how do you make AI almost like a coworker and a friend opposed to a threat? Because I think sometimes we think AI is elimination of job opportunities. It actually is a benefit and something that can maybe aid, you know, your ability to actually get gainful employment.
I am curious, when you look at the kind of the landscape of the labor market, and we should point out, before you did OneTen, you were for years over at ADP. You were to be an executive there. I am curious as to how much it's changed, not just in terms of meaning us, the workers, but also what employers really demand, what they look for, and really just what the world demands. Is it dramatically different from maybe when you and I were coming into the workforce way back when?
Yeah, I don't know if I'd say it's dramatically different. I mean, I think we've always had these sort of 3 philosophies. It's always about people, process, and technology. So making sure that you have the right people for the right jobs that culturally fit in your organization. I don't think that's anything different. But the pieces to me that maybe have evolved is, do you have the right infrastructure and process in place, which is where skills first comes in, and then do you have the technology, AI, and then some, to ensure that the workers or the talent is actually being set up for success. So it's not different. I think it's just evolved at a faster scale and pace than we've ever seen before.
Well, we hope you go from strength to strength. Debbie, thank you so much for coming in. Debbie Dyson, CEO of OneTen. Coming up, the top 3, where we focus in on the top 3 movers and shakers at the center of the day's biggest stories. That's next, so do stay with us on The Close on Bloomberg. Time now for the top 3. Every day at this time, we do a deep dive into the people at the centre of today's top stories. Up first, Rishi Sunak. The UK Prime Minister has apologised for skipping events to mark the 80th anniversary of D-Day in France in order to return early to the UK. He came under fire after it came out that he was filming a pre-recorded interview with ITV as part of his election campaign. Can this man not get the optics right? He already announced the election when it was pouring rain, when all he had to do was wait. Now he's making security and defence a huge part of the re-election campaign for his party, and he misses the D-Day.
Yeah, I think if there's any sort of #1 rule for politicians is always be mindful of the optics, and the optics on this certainly did not look good. I'm keeping an eye on Adam Newman. Remember him, the WeWork founder, is actually in the market, I guess, or at least trying to sell his New York City apartment. I don't know if you have $25 million laying around, Vonnie, but if you do, you can buy his New York City apartment. It's 6,000 square feet, 3 stories, plus it has a rooftop deck. It's over there in Gramercy Park. It could be yours.
Sure. Would I have to share it with workers? Is it an old WeWork?
Why? You might. Who knows? I don't know, but I'm sure there'll be lots of kombucha.
That's true. That's true. Yeah, I'll give it a think about. But we'll have to see if mortgage rates come down. I'm also looking at this idea that you can put an amount of $170 million and sue Netflix for that amount of money for Baby Reindeer. Fiona Harvey. I mean, where did you come up with those calculations? I'm not quite sure, but she's claiming to be the inspiration behind a central character in the hit series Baby Reindeer, and now she's suing.
Have you watched this show yet?
I have not yet.
Yeah, me either, but I do find this interesting here. $170 million claiming that she is the inspiration for this. I don't know, I feel like anytime you have a hit show like this or a hit song, there's always somebody that comes out the woodworks that says, hey, I was the originator of this, give me my cut.
I mean, I maybe wouldn't be publicizing myself if I had done what was suggested that I did. So, there's that too. So maybe is she defending herself? I'm not sure.
All right, a lot more coming up here on the program. When we come back, it's time for our next sub-segment where we look at the movers and shakers really setting up to potentially be the next big thing. Henry Davis.
The rapid rise of weight loss drugs like Ozempic and Mounjaro has food companies running to create new product lines to meet the moment. Nestle has already launched a new line of frozen foods, specifically targeting users of those drugs. Joining us now is Bloomberg's Dina Shanker with more. How does it work, Dina? Because apparently if you're on these drugs, food is just not as palatable to you. So what are these companies doing?
So what Nestle has announced is that they are going to release a new line of frozen foods, specifically targeting the users of these drugs. They're going to have high protein pasta, pizzas, sandwiches, and they'll have gluten-free options available, all with the idea that anybody on the Ozempic and other similar drugs are looking for healthier, high-protein, smaller portion size options.
Is there any sense here that now is the time to do that? And I ask that because anytime we bring these companies on, they always talk about this idea of the percentage of the population using these drugs. It's still minuscule despite all the hype that we give to it here. So are they getting maybe a little bit too far out in front of this?
What I've seen is really a split in how the food industry is expecting these drugs to impact them. There are some people who say this is going to be a huge shift for the way food is consumed in this country. Other people say it's going to be a really small impact on just a very small number of consumers. And we can wait and watch and see what happens, but don't expect too much. So Nestle seems to be, betting on it being a really big shift in how we eat.
There are so many categories of sort of diet foods or healthier foods, right, Dina? How will these be marketed? And beyond Nestle, who else is doing it?
So Nestle is the first one that we've seen with a packaged food option that will sort of look like any other packaged food. We have seen some high protein shakes and that kind of thing that are targeting GLP-1 users. But as far as major companies putting packaged foods in supermarkets specifically with this target, Nestle is the first that we've seen. They're going to be high protein, which is really a trend that goes beyond people on GLP-1 drugs. And so, they'll also be smaller portion size, though. So a lot of people who aren't on these drugs might not appreciate that part of it because we, even when we're trying to be healthy, we tend to like big portions.
All right, Dina Shanker there. A nice segue here into our next up segment where we do highlight the entrepreneurs and founders out there moving the needle for our economy, the markets and technology. And our next guest is head of a company that's premium meal plan offers top ingredients for the body, the mind, and the soul. Sakara. It's a direct-to-consumer food delivery service. I'm pleased to say that the CEO of that company joins us here in studio, Henry Davis. Henry, great to have you here on the program.
Thank you so much for having me.
Yeah, I mean, you are a CEO. You are also a venture capitalist, a funder. You were instrumental in building and helping to launch Glossier. And now you have this food company, which I don't know, maybe it was planned, maybe it's just inadvertent, but it looks like it might be arriving at a good time. You heard Dina here. I mean, we are thinking a lot more here about how these weight loss drugs factor into our diets. And even those folks who aren't on it, I think we're thinking about it as well. Do you think you can take advantage of that?
I think that we see so much change in wellness at the moment. This is a $1.8 trillion
dollar industry globally. $500 billion of that is in the US alone, and it's growing 5 to 10% a year. So the numbers speak to that. But even just anecdotally, speaking to anyone on the street, the conversations you have about weight loss, sure, but also mental health, sleep, and you can name 10 other things that are so much more in the conversation than they used to be.
For those who aren't familiar with the product itself, explain how this works, because these are prepared meals, right? That you're basically delivering to folks in kind of big batches, right? So I can order, I don't know, what, a week or a month or what?
Yes, we prepare whole food-based nutrition products, meals, as well as supplements to give you beauty-forward wellness benefits and really focused on everything holistic wellness. We want you to feel as good as you look, and be sort of beautiful from the inside out.
So you have the experience of coming to market at a time when there's an inflection point, right? So with Glossier, that was huge. It really caught on with the younger generation. You know, it was like Kylie Cosmetics. It was like all of these sort of direct-to-consumer brands that did really, really well. Now we're at another point for all these meal services, because it's not just Sakara. There are so many of them. I'm getting constantly offers to join and to subscribe to all these. How long do you have before that craze goes away?
It's interesting you referenced the direct-to-consumer moment. I think that speaks to what's going on now. That was a seismic shift in the way consumers wanted to engage with brands. They no longer wanted to be disintermediated by retailers, and they wanted to have a say in the things they were buying. Consumers now want a say in their own health. They no longer want to be dictated to by large corporations and previous ways of getting food. They want to be able to take control. And so the rise of services is meeting a growing demand.
But why should I believe you? You're going to boost my energy, you're going to ease my bloat, but how do I know that? What are the scientists telling you that they're not telling us?
Whole food nutrition, I think Michael Pollan said it best, is eat real food, eat mostly plants, and don't eat too much. I think the fundamentals of wellness have always been true. There will be lots of pseudoscience and things thrown around, and we'll get served ads on the internet, but fundamentally, you eat high-quality ingredients in the right portion sizes, that will do good for you.
I want to talk a little bit about running this business. We introduced you as the CEO. We did not introduce you as the founder, because you did not found this company. This was founded by two women right here in New York. I mean, they have a great story. Their little tiny New York apartment, which everyone has a tiny New York apartment. But, you know, this was a great success story. When were you brought into this, and why?
I joined at the beginning of this year. The founders have been running the business for 13 years from the roots that you talked about, their own personal journeys leading them to start the business from their apartment. And they'd scaled it to a very sizable 9-figure business. And they wanted to take it to the next stage. To do that, they wanted to step up into a role where they could be ambassadors for the brand and the lifestyle, and really talk wellness and directly with customers about that. I am a business builder and have done that previously, and came here to do that again.
So part of building a business, of course, as I'm sure you know, is raising money. I mean, if you have those types of ambitions here, how successful have you been in raising new capital? Do you have any plans to raise further capital? And if so, in what market do you plan to do that?
Sakara has been remarkably well run in terms of capital efficiency. They have not raised a lot of money before I joined. We are profitable. We do not need to raise more money, having been a venture capitalist.
So you're making enough profits where you can put that back into the business without having to bring in new investors?
Absolutely.
Okay.
As a venture capitalist, whenever there's an opportunity to raise money and put that to work in a way that will drive growth, we will do that. But right now, we don't see a need.
So give us a few more details, if you would. How many people do you have on your platform? How much did you pay for each person, and how are you so profitable?
So we have served over 500,000 customers in our time. We are lucky that 70% of our customer base is repeat customers. So that sort of answers the profitability question. If we're not chasing customers around the internet, but we have loyal customers who love what we do, they become a marketing channel for us. What's amazing about what we do is when it works, it changes how people feel. And when people feel better, they want to talk about it. And that becomes a lovely flywheel that leads to other people hearing about it and then feeling better themselves.
Just one final quick question, though, too, because, I mean, you mentioned how long ago this company was started. And, you know, that's going to raise a lot of questions as to how long, if at all, you stand to stay a private company. Have you had discussions at all about a path to being a public company?
Right now, we feel very comfortable as a private company. We have all the capital we need and access to capital that we will need in the future. As and when the strategy necessitates something different, we are very open to that, for sure. But it's not something that we are planning on at this current time.
Absolutely, the very best of luck to you, Henry. I am going to talk about the website a little bit now, so you might want to close your ears because it's not cheap, Romain. It's a $239 weekly plan, and that's just 3 days a week. For 5 days, you're talking about $420. I mean, your wellness is everything,
well, that's
right?
Your mind, your body, and your soul.
And your soul.
Isn't that priceless, Vani, Quinn?
Not quite sure where
I don't know. I mean, yes, the prices are certainly on the premium side here, but look, I mean, they're going for a certain audience, but it gets to the question, too, as to what type of customer is going to actually not only be willing to pay it, but really kind of stick with it as well. Because we've seen some of these meal plans crop up. People experiment with them a couple months and then they move on to something else.
For sure. He did say 70% are repeat customers. How long they are repeat customers for, I suppose, is a question. But, you know, you're going to give these things a little time. You have to give them a little time for them to work. And certainly the meals do look delicious.
Yeah. All right. Well, our thanks to Henry there.
But Romain, you feed my soul, so I don't need a program for that. I don't need a subscription for my soul to be fed on a daily basis.
Vani, just stay there. Flattery gets you everywhere with me here. Meanwhile, though, we do need to look at the markets, Vani. Here it was quite a day and quite a week.
Yes, it certainly was. We are down just on the day, but when you think about it, we are also just at the beginning of June, and there was a lot going on this week, including a really surprise jobs report, which maybe has investors scratching their heads just a little bit. What will it mean for the Federal Reserve? What will it mean for corporates? Certainly for small caps, it doesn't look good. The 2-year yield and the 10-year yield, we are looking at a major lift across the curve.
This is Bloomberg.
They're in the transformation stage here, and what could they transform into? You know what I mean? There's a lot of question marks about that, understandably so. But essentially it becomes at this stage of that second part of the analysis, this transformation part, it becomes a bet on the management.
And that is Keith Gill, a.k.a. Roaring Kitty, a.k.a. Deep Value, discussing his investment in GameStop. Once again, a rare appearance on YouTube. Remember, he had ditched the platform as well as all social media a while ago, making a big return over the last few days and weeks. And the end result of it was, well, GameStop shares tumbled today, down about 40% here after the video game retailer kind of beat Keith Gill to the punch, unexpectedly releasing its latest results and also announcing a plan to sell as much as $75 million in additional shares. Bailey Lipschultz joining us right now, talk a little bit more about this. And Bailey, I don't even know where to start. This just seemed like an absolute mess of a day here. First, we got the GameStop earnings, which weren't supposed to come out. They were bad. Then we had this share announcement that could be dilutive. And then Keith Gill starts his webcast, what do you want to call it, 25 minutes late. And I don't know what I learned here. Did you learn anything?
Well, Romain, we learned if we trust him, Keith Gill is the actual investor who holds all those shares. So according to him, when he pulled up his E-Trade account on that live stream, the 5 million shares is in his E-Trade account. Those 120,000 June calls that have a $20 strike price, again, according to the stream, belong to him. He had come out saying he's not working with anyone, that he, in fact, has been behind the activity both on X and on Reddit. So at least that clears up. Again, if we trust him, all of that uncertainty. But again, Romain, before that release, there was a lengthy disclaimer basically calling out a number of things that were not in past Roaring Kitty videos.
Well, I am curious about something, too. And he actually looked good. I mean, he looked a little slimmer, healthier. I don't know what was with the Band-Aids on his face, if he cut himself shaving or something. But did he address at all some of the speculation around? It's not just the fact that maybe he wasn't the true owner, but also the speculation about whether E-Trade and Morgan Stanley wanted to kick him off the platform and all these other issues?
He made a joke about it. He basically seemed to imply that he could use Photoshop on those screenshots. I'm not going to try to read between those lines too much, but he did address that, which was quite interesting to see him kind of address every type of reporting that we've seen over the last few weeks, from the questioning from the likes of Andrew Left about whether or not someone's backing him, to your point, to Morgan Stanley or E-Trade potentially wanting to kick him off the platform. He really laughed about all of it. And those Band-Aids, he started out the bit with kind of a joke that he was coming back to life. So there was something alongside that when he kind of really kicked off the live stream.
He also said he didn't really need the ice pack, which made me think, how do we trust you if, you're appearing with even, like pretending that you have wounds that you don't necessarily have. But, lightning doesn't really strike twice, it seems, Bailey, and it does look like investors are a little bit more skittish this time round. And it should be said that today we're down 40%, but we were up 47% yesterday, so we're still higher on the 2 days. But he doesn't have a different fundamental case. At least he didn't give one today, and there was a lot of halts in trading, and he didn't want to speak during the trading halts, so maybe that had something to do with it. But he effectively came out and said, yeah, look, I'm just back to say hi to you all. I missed you, and, really it's just the same thesis. We're just in part 2 of that period now.
No, exactly, Ivani, and that's the thing, is that he came out just backing publicly Ryan Cohen. That led to a number of speculation. The company does have its annual meeting next week. Could there be some kind of surprise from that? Remains to be seen. But the big thing had been 2 parts of his thesis back in 2020 and 2021. Massive short interest. That's no longer the case. And a faith throughout the end of 2020 and into 2021 in Ryan Cohen transforming the company. But when I talked to Michael Patra over at Wedbush, who's really the only analyst on the sell side who still tracks the stock, he hasn't seen any type of strategy. And even Roaring Kitty himself kind of said, we're still in a transition period. We're waiting to see what he does, but give the guy more time. And if you're a critic, you point to the fact that Ryan Cohen really has been at the helm for about 3 years now. And as far as we know, sales are still either flat or declining depending on the metrics. And there hasn't been kind of an aha moment about what the company is going to do other than allowing Ryan Cohen and a couple of members of the management team to actually invest the cash the company has.
He also said several times, with all the disclosures and, the right to change your mind about certain things at certain times, he also posted a U-turn card during the week on Twitter, on X. So it makes you wonder, what transparency do we have about how much he's actually worth when it comes to GameStop's price right now, what he did today, what he might do on Monday? We have no idea, right?
No, we have no idea. There's so much uncertainty. That reverse card, the interesting thing is if you look back at some of his older videos, he had an entire video on investing off of vibes. And the reverse card was essentially about flipping a ticker around that you could buy. So it doesn't really make sense what that could mean in the context of GameStop. But nonetheless, he commanded everyone's attention. And I talked to a number of investors and traders at some bulge bracket banks who kind of were making jokes with me that they were taking their lunch break around noon to watch a guy who goes by the moniker Roaring Kitty on YouTube talk about a meme stock that most fundamental strategists would say does not trade on fundamentals. But here we are in 2024, I guess.
Yeah. Fanny, have you ever played Uno?
Uno?
Yeah.
No.
Oh, I didn't think
Marjan.
so. Huh?
Go, Marjan. Never Uno.
I know Bailey. Bailey's got to be playing.
Chess.
Why he's out there at his beach house or wherever he is. Bailey, I do appreciate you at least taking time for us on this Friday afternoon, even if it is from your palatial house there out in East Hampton. Bailey Lipschultz has been covering meme stocks for us for a while. An exciting week once again. We should point out, despite the fact that GameStop was down about 40% on the day, it still was up on a weekly basis. A big story to watch in the week ahead. And we're going to set you up for the week ahead. A lot of big potential market-moving events, including Apple's Worldwide Developer Conference. A conversation after the break. This is Bloomberg. All right, some big events next week that investors need to keep an eye out for, and that includes Apple's Worldwide Developer Conference event on Monday. Mark Gurman joining us right now to talk about what to expect. And Mark, it seems like, at least based on your reporting, some of the other reporting I've seen, there is going to be a lot of talk, I guess, about Siri and AI.
AI is going to be at the forefront of the Worldwide Developers Conference on Monday. Apple's going to announce a new service called Apple Intelligence. The idea here is, in a thoughtful, privacy-preserving way, to integrate AI features across iOS 18, the new iPad operating system, and the new Mac operating system. You're going to see things like summarization of incoming notifications, automatically replying to text messages and emails on your behalf, classifying incoming emails using AI into folders, transcribing voice memos, improvements to messages using AI, including AI-created emojis. So a through-and-through push AI across the iPhone.
Is there any trepidation at all about people actually wanting some of this? I mean, I'm not quite sure I want AI responding to my emails.
So this is going to be a beta, right? It's not going to be a fully launched product at this point. It's going to be a test or a preview, so to speak. It's also going to be opt-in, so users are going to have to actively choose whether or not they want to use the Apple Intelligence service. There's also going to be another component, which is quite interesting. This is a partnership with OpenAI. This is for a chatbot. This is the generative AI portion. Apple's new AI technology is mostly a continuation of what they had been doing previously. The generative AI portion, that's what a lot of investors are so excited about. That's the OpenAI part we've been talking about.
What else should we expect out of this? I know these events, we don't really get kind of the hardware updates that I think most consumers look for here. But when you look at what they're going to talk about here, does that kind of lay the groundwork for maybe what we should expect later this year when they do actually announce new hardware?
Well, I actually expect these AI features to be exclusive to the iPhone 15 Pro, which means that if you want these AI features, that means you have to have the latest iPhone. There are so many people with a 15 and lower, or an older, I should say. So that's going to drive a lot of sales this fall, an iPhone 16 supercycle, so to speak. That's the AI phone that investors at Wall Street have been clamoring for, because a very small percentage of the overall user base right now is going to be able to support the new AI features. If you want to get in on that, you're going to have to buy this year's phone. So that's going to be a pretty considerable portion of this. Now, they're not going to say that on Monday, but they will say it's only the 15 Pro for now.
All right, Mark Gurman will be all over this on Monday, a big day for Apple, and kind of fitting it's going to be a big day for the close here on Bloomberg Television, a relaunch of our program with a new look and a new feel. We will have full coverage on Monday of Apple's Worldwide Developer Conference, and in fact, a big focus on tech that day, Bonnie, including with Sam Palmisano, the former IBM CEO, Steve Wozniak, one of the co-founders of Apple, and Jana Eggers, a huge mind in the AI space.
It's going to be a very exciting day, and I, for one, will be tuning into that. I'll be, like I was today on YouTube, 10 minutes beforehand, just waiting in line to see 3 o'clock Monday, the new close. As you say, fantastic guests. You've Bill Gross, the PIMCO co-founder as well, the Bond King. And then, of course, later on in the week, the guests don't stop coming.
We got earnings on Tuesday. We're going to get Oracle earnings that day here, so the focus on tech continues. And you kind of alluded to it there. On Wednesday, we get a big day. Not only do we get the FOMC decision in the afternoon, Bonnie, but we get the CPI data earlier that morning.
And you get to hear from Jim Chanos.
Yeah, Jim Chanos will be on the program, a sit down to really kind of give us his perspective on everything going on. We're not only just about the macro, but of course we're going to ask him about short selling, GameStop, and everything else in between. And then on Thursday, we got a big day for Tesla. They have that annual general meeting where everyone's going to be talking about that $56 billion pay package that Elon Musk has been asking for.
Exactly, and it doesn't end there, because on Friday, the Bank of Japan decision comes, and you know you're going to be seeing a market reaction to that as well, with the yen weakening past 156 once again this week.
A new look and a new feel, but with all of your familiar faces, Romaine Bostick, Alex Steele, and Scarlett Fu will all be back in Studio 2 on Monday morning. Our thanks to Bonnie Quinn for filling in today. Stick around. Balance of Power is coming up next, right here on Bloomberg.